Hey all, Choiboy here. Welcome to another video, and today I'm gonna start a series called Investing for Beginners. And what this is for beginners who want to get into personal finance and investing and stuff like that, and just to make your life easier, because I've been getting comments about fundamental questions that people should already know, but it just seemed to me that everyone was more interested in just making the money instead of actually understanding a lot of things. Today we're going to be talking about the old and new era common terminologies, just words that we might see while researching or looking through Reddit or whatever your research is, just some words that you might encounter which would make your life so much easier and understand the article a lot better if you knew some of these words. Just before we get into it, just a disclaimer, I'm not a financial advisor. Please take everything I say with a grain of salt because it's not financial advice. Cross-check my information with your own research and do your own due diligence. Enjoy the slides and let's get straight onto it. So the first word you might see a lot nowadays is FOMO. FOMO stands for fear of missing out. It's a term that's being used when you are kind of panicking into a opportunity. A recent FOMO that might be a good example is the GameStop stock. When GameStop went from like $10 all the way to like $400, a lot of people FOMO'd in maybe around the $50 to $100 mark. It just went crazy after that, right? The thing is that a lot of retail investors started FOMOing into GameStop because it was just going crazy. It was going like 5x pretty easily, then 10x, and people started FOMOing a bit later. We use the word FOMO when you are kind of late to the game. We don't really use the word FOMO as a good thing. Some FOMOs might end up well, but a lot of FOMOs actually don't end up well. For example, GameStop went all the way to $300-400 ranges. The people who FOMO'd into GameStop during the $300 and $400 marks and never sold, they're currently looking at a price of $110-120 or so. A simple way of describing FOMO is you're just trying to get on the hype train, which is a bit too late. A lot of experienced investors would tell you not to FOMO in, do your research, get in early and just hold it. And FOMO is exactly the opposite. That's the first word. Okay, second word is all-time high and all-time low. So these ones are simple. The first one, all-time high, is the highest price it reached during its time in the market, and all-time low is the lowest price that it reached during its time in the market. A good example of how people use this word is like, oh, I bought it at the all-time high. That's a pretty common saying, like I bought it at the peak, I bought it at the all-time high. So just keep in mind if you see ATH or ATL. Alright, third one is DYOR. Do your own research. If you read through Reddit, for example like Wall Street Bets, you can see a lot of DYOR. The thing is that no one should be investing purely because someone else's research looks good. You always got to do your own research. You know, some other people's research might be good. It might actually be legit, but you do have to do your own research and cross-check it. That's what I always say to you guys. Everything I say is not financial advice. I know I could be wrong, and I don't want to lead anyone in the wrong way. So it's always good to have a little bit of doubt in all the internet people out there, because not everything on the internet is true. Do your own research, pretty simple one. You might see that a lot when you're reading forums and when you're talking with young investors. Fourth one is DD, due diligence. It's kind of like do your own research, okay? Do your own due diligence and just invest based on your facts. That's literally what it's saying. And on Wall Street Bets, you can see people post up their DDs, GameStop DD or BlackBerry DD. That just literally means my research on GameStop or my research on BlackBerry. It's pretty simple. Remember, it is due diligence. The next one is bull and bear, and sometimes it's used together like bull market or bear market, or something like bull trend or bear trend. You just got to know what bull and bear means. Bull means it's going upwards and bear means it's coming downwards. And when you say you're bullish on something, you're thinking it's going to go up, and when you're bearish on something, you think it's going to go down. You can put anything at the end of it, market trend, whatever pattern, it doesn't even matter. So bull means up and bear means down, normally in terms of price action. Alright, next one is pump and dump. I think people might have heard about this one. Pump and dump can be used together or separately. Pump means pumping the price up and dumping means dumping the price down. So it's kind of like a bull and bear situation here. Specifically, a phrase called pump and dump means a price is pumped, like normally quite significant amounts, then it's being dumped as soon as possible. So it's normally a very short-term thing. There's a lot of illegal market manipulation and whatnot. Pump and dumps happen a lot in cryptocurrencies as well, even in stocks. It could also be an illegally synchronized action or a group action. There's a lot of things that could happen in a pump and dump, but normally it's not a good thing. Pump and dump and FOMO normally goes together, because when a pump and dump happens and when the price action is going up really fast, people FOMO in. As soon as the majority of the latecomers join and FOMO into the stock, it starts to dump. So that's like a little bit of an example of how these terms could be used together. Next one is a correction. A correction is when we have a price action downwards from the all-time high of 10% or more. A correction normally comes after it has rallied a bit. We will always have some kind of correction, whether it comes earlier or later. That depends on what stock it is or what fund it is. Eventually we expect a correction for the stock or fund to continue upwards in a healthier and sustainable manner. A lot of people think correction is not good, but correction in the price is very, very important for sustaining a healthy market and creating support levels in the price, because the higher it goes without creating proper support levels, it is bound to fall quite a lot when a correction actually comes, and it becomes more major if it has been growing without any even minor correction. So this is really important. It's not always a bad thing. It is crucial for any stock, cryptocurrency, any investment in general, to have a bit of a correction for the longer term benefit. Next one is consolidation. What happens after a correction? Sometimes we go into a phase called consolidation, or sometimes it's not even after a correction. Sometimes after it hits an all-time high, it might consolidate for a good, I don't know, few months. Consolidation is when the price action is very minimal between a very small price range. We also say things like the market is moving sideways. That's a consolidation. It is consolidating the current levels before it starts going up again. So a correction and consolidation normally comes together. Sometimes a correction might not come, but a consolidation might come. It really depends on the investment. So next one is dollar cost averaging. When someone says you should just DCA it or dollar cost average it, it is talking about regularly investing over a long period of time. Funds are probably what people dollar cost average on the most, because it is diversified, normally quite consistent with its annual returns, normally a better option than keeping your money in the bank. And that's what a lot of people do, because a lot of people don't really have time or really that much motivation to kind of research all these stocks and whatnot. There are people who dollar cost average on stocks as well. It really depends on your own strategy, but dollar cost averaging is not a bad idea. People would dollar cost average because they don't know where the bottom is. If they know where the bottom of this graph is, then they can just put a large lump sum at the bottom of the price. But because that's not the case, we can't really predict anything. Let's say you bought it at the peak and the price starts dipping, but in the long term you see it going up even higher. Then because you don't know where the bottom is for this correction or so, people just buy a bit as it's going down. And what that does is you're lowering your average buy-in price. So let's say I buy a bunch at 20, then I buy a bunch at 15, another bunch and 10, then let's say I put 50, 50, 50. My average buy-in price would be $15. So that's the power of dollar cost averaging. It really works well with compound interesting and stuff like that as well. Don't forget dollar cost averaging, because normally it is a better thing to do than trying to time the market. Next one, fund. What is a fund? I just talked about dollar cost averaging on a fund, but what is a fund? There are lots of funds. I'm going to talk about two this time. One is called mutual and one's called index. Mutual is like an actively managed fund. It's when a fund manager actively puts and takes out stocks in their fund. It's diversified, same as an index fund. On the other side, an index fund is passively managed one. It just follows an index. For example, the S&P 500 or the New Zealand Top 50 are both index funds. I say mutual and index are like the two main ones for most regular investors like us. While the index fund follows the market trend, the mutual funds would try to actively manage it so it beats the market trend. So that's the main differences. The fees are normally higher on a mutual, so do remember that as well. I personally like index funds more than mutual funds, but it really depends. Alright, so the next ones are pretty fundamental. Share price is equal to the market cap over the shares outstanding. For example, if a company is worth $1 billion and it has 100 million shares outstanding, the share price is $10 per share. Pretty simple. This is exactly why share price don't really matter. When people say, oh, it's too expensive when the share price is like $2,000, couple of $10,000, it doesn't really matter. You should be looking at the market cap of the company, not the share price, because the share price can change depending on how many shares they have outstanding, and not all companies have the same amount of shares outstanding. Just because you can't afford to buy one whole share of a company does not make it expensive. It depends on the market cap. Next one is day range, normally referring to the price of the stock or fund. Day range normally shows you the high price and the low price of the volatility for that day. For example, let's say company A went up to $1.20 today, then it dropped to 90 cents, then it closed at $1, meaning the day range for that company for that day was 90 cents to $1.20. Next one is closing and opening price. I just mentioned closing price because we all know that the market opens and closes every day, and normally it's during the weekdays. Not many people can trade outside of these trading hours. Some stocks on some brokers can trade after hours, but let's talk about the general market times. So let's say it opens at 10 o'clock and it closes at 5 p.m. The opening price is the price when the market opens, and the closing price is the price when the market closes at 5 p.m. The next one is trading volume. So trading volume normally refers to the day's total amount of money that has been bought and sold for that stock or fund or whatever investment it is. The higher the volume, there was more trades going on, therefore something is happening with the stock. And normally ones with high trading volumes for the day is normally known to be a popular stock of the day, or it could be a weekly or a monthly thing as well. It really depends on the period of time we're talking about. In general, it just means the total amount of shares bought and sold. Next one is the PE ratio, share price over EPS. The PE ratio normally kind of shows if a company is overbought or undervalued. It really depends on how you use it, but it's not the only metric you should be looking into when you're trying to research about a company's share price. I put the formula for the EPS below. EPS is the net income of the company over the shares outstanding. So you're trying to see the earnings over the number of shares they have, then you get an EPS, and you're trying to compare the EPS to the share price. What the PE ratio is trying to look into is to see if the market price of the company is fair compared to the company's earnings. Pretty simple one, pretty common one. Next one is the PB ratio, and this is also called the price to book. It's pretty similar to the PE ratio, but instead of comparing the share price to the earnings, you are comparing the share price to the book value. The book value is pretty much all the assets it has. So a good way to look at book value is if the company dies today, what is it worth? Selling off all their assets and all that kind of stuff, that's normally the book value, and divide that by the shares outstanding and you compare that book value to the share price. Just a different way of looking into a company and researching and to see if it's overvalued compared to its assets or something like that. So that's the PB ratio. Next one is the assets and liabilities and equity. This is the accounting formula, and normally you can see assets, liabilities and equity in the balance sheet. And what this is trying to say is that your assets should be the same amount as the liabilities plus the equity. Assets is kind of like physical buildings, equipment, and all these kind of assets that normally depreciate. Liabilities are anything you own, they don't depreciate because you own it, and normally you're paying an interest on top of it. It's things like tax, debt, and all that kind of stuff. Things you've borrowed from people, loans, that's a liability. And equity is pretty much all the capital raised, how much shares it has, any reinvested earnings, stuff like that are normally equity. So those three are very important. I'm not going to dig too much into these ones, but that's roughly what each one of these are trying to tell you. Last one is dividend. Some companies pay dividends and some don't, but dividend is practically when a company makes earnings, they're sharing those profits with the shareholders, and that's what you get as a dividend. And some companies don't pay out their profits to their shareholders, but instead they reinvest their earnings back into the company to grow the company more. And normally that would increase the share price of the company in the long term. So there's two ways a company can really use their earnings, and those are the two ways of doing it. I'm pretty sure there's a lot of videos out there that talks about what a dividend is, and you know, with all these nice visuals and stuff like that. So I'm probably not going to make a video on it, but that is the summarized definition of a dividend. So that's pretty much it. If you like today's video, give it a thumbs up, put a comment down below what you thought, subscribe to the channel if you're watching this without subscribing.
I'm looking at you.
Put the bell notification, and I will see you in the next videos or live streams. Until next time, I'll catch you around. See ya.